The real question is, can the European economy shift fast enough to match these targets? And will it be an economic drag or an economic benefit? How will it unfold? What's your view?
So we've been writing a lot on this issue about the role of climate in affecting economic activity. And when we think about it, we think that the real key question for recovery, not just rebound, but recovery in Europe, as well as other economies, is to catalyze private sector investment, real side investment, because capital investment has absolutely collapsed. To do that, you have to combine spending, tax, and regulatory changes in order to create an environment where the private sector actually has to spend money on real stuff or intangible equipment, if we want to talk about technology. So how do you do that? You have to have a fiscal pivot towards something that is going to demand private sector response. And climate is it. So by putting forward both the money and I hope the regulatory changes as well, she has set out a target, an objective, and a vision for Europe, which does represent this fiscal pivot, extremely important. And not only is it good for private investment, but of course, there's the financing side as well. And we know investors want those green bonds. We could also talk about the ECB maybe buying them, but this is a really good package for Europe.
That was actually my first thought when I saw that number that they were going to issue in green bonds. I'm like, oh, well, the ECB is just going to buy them. I mean, is that what's going to happen? We're in essence going to have a backdoor financing for all this green investment?
Well, I think the ECB is going to have to fight the private sector for it, because the private sector wants these green bonds in their portfolio as well. Not only sort of the private investors, the pensions, and so forth, but also we find that the outperformance is advantageous, and of course banks want to be part of the action too, because of the FSB's risk assessment of the portfolio of financial institutions to climate risk. So there are a lot of actors out there who want these kinds of bonds. We have to make sure that the private sector investment activity is designed to take advantage of having this financing available, because again, CapEx is where it's at. And we need to have private sector, we need to catalyze private sector investment in order to actually get to a better place from a standpoint of GDP
getting in on the act.
And jobs.
Yeah, well, Volkswagen getting in on the act as well, issuing green bonds as well to fund electric cars. Daimler's doing the same thing here in Europe. What impact on the bottom line is this going to have? If we do get this crowding in effect from the private sector, what impact on GDP are we going to see, and how quickly does that come through?
So again, a number of weak spots post-COVID, but capital investment is the key one. Without capital investment, we're really not going to have any kind of recovery sufficiently strong to generate profits for firms, generate pricing power for firms, generating wage growth and employment for workers. So we're really talking about a critical component of getting us to a recovery phase. And what we've done work on, my previous job at chief economist at the OECD, we did work for the G20 that showed that this combination of tax spend and regulatory changes is one that is growth enhancing. And it can be in the short term. It can be in the short term and the long term. Why in the short term? Because firms have to get ahead of the game. They want to be the first ones in order to get the best price for their purchases and for their bonds.
So what's interesting, Catherine, is U.S. has been looked at as the growth play because of technology stocks. And Europe is the value play. They don't have any real technology companies. Does that dynamic then shift? I mean, are we going to be talking about Europe as the growth driver in the next, 8, 12 months, 16, 18 months because of this shift?
I think it's a very important question about the outcome of the U.S. election, frankly, because that could change the position of the United States vis-a-vis the climate change agenda. And so I think that's a critical question going forward. Right now, Europe has the potential for the growth play. I mean, we're seeing it playing out in the foreign exchange markets, somewhat to the detriment of the inflation target of the ECB. But nevertheless, that is right now the assessment of the markets is that the potential for European growth coming out of this is more solid than what we see for the United States.
Interesting.
You mentioned the OECD. Angel Gurria out a little bit earlier on, raising forecasts really quite significantly, certainly for the United States, China, and the Eurozone. And we've seen some very solid data out of China. In terms of our understanding of where we are in this process, clearly it wasn't as bad as first thought. We have bounced back quite sharply. The data are certainly showing that. My question is, where are we now? And has the improvement in the economic data kind of reached its peak? Are we now going to see a much more sideways story in terms of the way that that data develops?
So what I have to say is that the OECD may have raised their forecast, but we're continuing to downgrade ours. So we're kind of maybe meeting in the middle. I'm not quite sure. And the reason why we're downgrading ours, every month we do a new forecast. And what we have been doing is, what has happened is that more and more countries are putting out into the future when they expect, and this is from our country economists, when they expect their countries to achieve the pre-COVID level of GDP. The US and China have stuck with their dates, but everybody else has moved out, or most countries have moved out. And that's where I say it's a very fragile global recovery, because it's very asymmetric in terms of timing. And you know that things cannot do well when you've got a couple of countries projecting to be coming out sooner, but everybody else coming out slower. It means trade will not recover. It is also the case that all of our country economists think that the weakest point in their forecast is business investment. So I get back to this question of, how do we catalyze private sector business investment, make businesses use all of this debt that they've taken on? Your previous segment talking about M&A. Let's just face it, M&A is a great thing to do with your cash, but it has nothing to do, does not benefit growth or employment.